Good afternoon, everybody. Thank you for joining this latest in our webinar series highlighting Rival One's capabilities. I know that having a webinar during the trading session can be difficult to get everybody on board, but this is being recorded. So for anybody that has registered but is unable to attend this session at the moment, you will be receiving a recording of this webinar. And you can view it anytime that you like. As we are going through the features, if there are questions along the way, please go ahead and put them into the chat. I will try and answer any questions on the fly or at the end if there are questions at the end. The follow-up email will also share my contact information so that if there are questions after the session, or if anybody would like a more detailed dive into either the spreader component that we're going to talk about today or anything else on the Rival One platform, we are available to you at any time for questions. With that, I'm going to jump into today's webinar. So we are going to talk today about Rival One's spreader tool. The spreader tool can be very powerful because it can be used to create synthetic spreads either within a single trading venue or a single exchange or across multiple exchanges. In addition, the spreader can be used to trade multiple asset classes, which is unique in our industry, and I'm going to get into that a little bit when we talk about creating a spread between futures and equities. I'm going to start with a very basic spread today, but I want to just do a quick overview of what you are looking at here in my workspace. So in the top left corner, I've got my hot watch separated with a couple of index symbols and equity symbols, and in another tab, a couple of energy symbols because we are going to create a CL spread today, CLBRN spread today. So we can keep an eye on our energies that way. In the upper right, I've got a ladder display of market. We're looking at the ESDs contract right now, but we're going to use that to view our spreader orders and trades. I've got an order book and a trade book in the lower left-hand corner here, so we can see what those components look like when a spreader order is working and when a spreader order is filled. On the far right, I've got my portfolio filtered for any positions in the instruments that we're going to be looking at today. And then, of course, here is our spreader component, which in and of itself is very basic. But as we go through it, you'll see some of the intricacies and complexities that can be used with the spreader component. What I want to do first is create a very basic two-legged spread with the ES or S&P futures versus the NASDAQ NQ futures. Since these both trade at the CME, this is a very basic setup, but I am going to create a spread to trade one versus the other, and we're going to see how that looks when we build the spread and when we execute it. To create the spread, I'm just going to hit new to create a new spread, and I'm going to give it a name. We're going to call this ES versus NQ. Obviously, you can call it whatever you like. And I'm going to start adding the legs of my spread one at a time. So my first leg is going to be, we're going to use the ESDs contract. You'll notice that our search does provide all symbols that fit your search criteria, including future spreads. Future spreads can absolutely be used as a leg of the spreader if you choose, and in fact, we do see some users trading a calendar versus a calendar to create a synthetic butterfly. That's a very common use case. In this case, we're just going to do a very simple one contract versus one contract, ES versus NQ. We are going to be buying one and selling the other. Because it's a two-sided market, it doesn't technically matter which is the buy leg and which is the sell leg, but this will tell us the direction of when we buy the spread. In this case, we're going to be buying ES and selling NQ. When we sell the spread, the opposite, of course. Quantity multiplier is the quantity in which we wish to trade. Now, in this case, because the ES multiplier at the exchange is 50 and the NQ multiplier at the exchange is 100, I'm going to trade this in a 2-by-1 configuration. So for every 2 ES contracts I buy, we will sell 1 NQ contract and vice versa. The quantity multiplier determines the ratio in which your spread trades. The price multiplier and this can be a little confusing for some users. The price multiplier simply dictates the displayed price of the spread. It does not affect the way in which the spread is executed. Rather, it affects the way in which the price of the spread is displayed on the front end. So you'll see what I mean by that when I make some changes here. What I'm going to do is I'm going to make this 3.5 by 1 ratio. And the reason that the way I came up with that is I'm just looking at the prices of the ES future and the NQ future. 3.5 by 1 is going to get us pretty close to an even money spread. Not necessary to make that kind of put those kind of multipliers in. You could certainly leave it at 1-to-1. In a 1-to-1 ratio, our price on the spread would be somewhere around 15,000. The difference between one NQ and one ES contract. So this is more of just a convenient, makes it a little bit easier to view the spread and execute it a little more comfortable, I think, for most traders. Sniper functionality, I'm going to talk about towards the end. We'll talk about what that sniper is. But for now, I want to talk about quote versus hedge. So when we create a synthetic spread, what we are doing is using one leg as the quote leg, or also known as the lead leg, and the other as the hedge leg. And what that means is that our quote leg will be looking at the prices in the hedge leg to determine where the order is entered. Once the quote leg is filled, we will fire off the hedge leg to achieve the desired price. For that reason, I recommend using the more liquid contract or the most liquid contract in your spread as the hedge leg. In this case, both of these contracts are pretty liquid, but ES being possibly the most liquid contract out there, we're going to use that as the hedge leg, and I'm going to use the NQ as the quote leg. We'll see what that looks like when we enter orders. Throttle inside ticks and throttle outside ticks. Throttle ticks are used to limit the messaging that is sent from your workspace to the exchange. This is often used in the case where users have either a large number of spreaders running, a large number of orders in the spreader, or very large orders. And so what the inside ticks and outside ticks do is limits the frequency with which the spread is repriced. Inside ticks will limit the frequency with which the spread is repriced as it moves toward your desired price. Outside ticks are as the spread moves away from your desired price. So some traders will use this to make sure they don't run afoul of the exchange. We'll set these to higher numbers than 0 to ensure that some of those reprice where we know that the spread is not close to our desired price. We don't necessarily need to reprice with every tick. That sends a canceled replace to the exchange on our quote leg, and we know that the exchange can sometimes limit the number of messages we can send, can even get into fines for when you send too many messages. In this case, I'm going to leave my throttle ticks set to 0 for both legs. What that means is that each and every time the spread price, the market updates, our spread price, our order price will update with it, regardless of how close or how far we are away from our desired price. So I'm going to leave those at 0. Finally, the last line here, the hedge tick offset. This can also be thought of as pay up ticks. So if you are willing to give up a tick in order to get a fill on your desired near your desired price, you can set this to pay up 1 tick, 2 ticks, 3 ticks. We do know, of course, the tick size for each contract. So if you the larger the number, the more likely you are to get a fill, but also the more likely you are to get a fill at a price worse than your desired price. Since these are both very liquid contracts, I'm going to leave this at 0 because I think that we're going to get a hedge almost no matter what because the ES is so liquid. In very fast markets, you may want to tick this up to a couple of ticks to make sure that you do get a fill on your second leg and that you don't get hung. For now, we'll leave them at 0, and we'll leave this as our basic ES versus NQ spread. I'll go ahead and save that. So we see our ES versus NQ listed here in our spreader. Now I talked about getting that price close to even money, and 3.5 by 1 does generate a price of this spread close to at the money. So half at 2 1 at 2. You can enter an order directly from the spreader. So if I click on the bid or the offer, I can enter an order directly from here at my desired price. Certainly for advanced users, this might be desirable, so you have less space, in your workspace, but most users will choose to execute this from the ladder. And so that's what we're going to do today. So now that I've got my ES versus NQ spread defined, I can drag that spread directly from my spreader window to create a new ladder. When I do, I'm going to drop it right here. We see that we're presented with a couple of options here about how to display our spread. Because this is a singular instrument, you can display a ladder for just the spreader instrument, or you can display a ladder for the spreader instrument plus each leg. This will open a separate ladder for each leg plus the spread body. Or my personal preference is to display the legs and the tabs. What this means is it will create one ladder, and we will see both legs plus the spread in the tabs. I'm going to actually do both here for the purpose of this demonstration. So I'm going to start by selecting all legs. So in this case, we are now going to have a ladder, and because of the way our canvas is built, sometimes it takes a little bit of resizing. But you can see now, I'm going to close my earlier window. You can see now that I've got my ES versus NQ spread. This is the market on the spread itself. We can see our NQ market and our ES market. So I'm going to place an order on the spread, and we're going to see what that looks like in the ladders, in the order book, and in the trade book. I'm going to place an order below the market here so we can observe it and hopefully not take a fill right away. If I place a 5 lot, I'm going to work to buy this spread at a price of -$3. So I don't expect to get filled on this, but I do want to demonstrate that now that I have a 5 lot working, if we look at our order book, we can see that in my ES versus NQ spread, I'm working to buy a 5 lot at -3. We also see that I'm working to sell a 5 lot of NQ. So this is our quote leg. And because I'm so far below the market, of course, my NQ offer is above the market. That's what this red line indicates, that there's an offer up above the market here. So I can scroll up and see that my NQ quote is working at 09 in the orders. It's going to hop around a bit. I won't try and track it verbally. But that quote leg is looking at the price of the ES and determining the price at which it needs to quote the NQ in order to achieve my desired spread price of -3. That is why we only have one leg, one order working right now in this spread. There is no working order in the ES and the hedge leg. That order will only get sent once the quote leg is filled. What I'm going to do now is try and take a fill on this spread, on this 5 lot, so we can see the behavior in the trade book, in the portfolio, and we can see how this is executed. So I can do this by simply dragging to the market, and it looks like I can get filled around $1. Let's see if I can get it. Yep, got filled at $1, paid $1 on 5 spreads. So we can see in our order book, and I'll get to the trade book in a moment. Oh, I've got somebody in my support group entering some CL orders. So we can see in the order book that we had our 5 lot of ES versus NQ filled on 5. We got filled on 5 of the NQ, and then we bought 10 of the ES against it. In the trade book, you get a little more detail. So if I look in the trade book, this is my ES versus NQ spread. You'll see next to it, we've got this little expander. And what that will do is it'll show us the legs of the spread and the prices at which each leg was filled. So we can see that ES versus NQ, we traded 5 by 10. There the prices are on individual legs. The individual legs will also carry the parent designation if it's part of a spread. So we've got the parent spread listed here, so we know that that's a child order. And then, of course, trader name, which is generic for this demonstration, and the account into which it was traded. You do have the ability to send different legs to different accounts in an automated fashion. I'm going to show how that works when we do a future versus equity spread. So what I've got here is I'm now filled on 5 of my spreads, entry price and price. And we can see our position, my position is updated in my portfolio, of course. We can see the legs of the spread. I did mention that when I put this spread into ladders, we do have the option of showing the legs in the tabs. As I mentioned, that's my personal preference. So just to get an idea of what that might look like, if I drag this spread up here, whoops, pardon me. If I drag this spread up here and I select show legs and tabs, my ladder is going to look more like this. So I've got now my, in 3 ladder tabs, I've got my ES versus NQ. Here's my spread. I've got leg A in the second tab. I've got leg B in the third tab. This can help with real estate in the workspace, things like that. So that is the most basic configuration of a spread, 1-by-1 spread within the same exchange. I'm going to close a couple of these ladders, and I'm going to demonstrate how we can build a spread across exchanges, although it's going to look very similar to this. So we do see some of our energy traders trading the CME CL contract versus the ICE BRN contract. So assuming you have permissions to trade at both exchanges, you can create a spread like this. So in this case, I'm just going to call this, let's just call it oil. And I'm going to use as my first leg the CL contract. Once again, everything with that CLZ4 is listed here, so you could use a calendar spread if you wanted. And my second leg is going to be my ICE BRN contract. In this case, I'm just going to do very simple 1-to-1, buy one, sell the other. I'm going to set my BRN as the quote and my CL as the hedge. I think CL is a little more liquid, although it's probably pretty close. Saving that gives me my my oil spread, my synthetic spread. I'm going to go ahead and create a ladder out of that. Let's do all legs again so we can once again see our spreader working. And let me hide that ES ladder so we have a little better view. And now, since this is a 1-to-1, this should be a very simple ratio. If I work to buy 10, I am once again selling the quote leg, the BRN, and I'm buying the CL leg. So I'm going to go ahead and take a fill on that. Let's drag that up to market, and I paid -4 on 10 spreads. Once again, in my trade book, if I expand it, I can see exactly where I got filled. If I do get partials, we do see that this is filled with a lot and 2 lot. And you'll notice that these accounts, I have my CME trades going into my support 01 account and my ICE trades going into support 02. And so I'll talk a little bit more about that when we look at settings. But easy enough to create spread that crosses multiple exchanges, not only within one exchange. And we do see a lot of users trading CME products versus ICE products. It's a very common setup. The next thing I want to look at here is what really I think it can be very powerful with Rival One. And since we are a multi-asset platform, since we support both futures and equities, we can use our spreader to create a spread of futures versus equities. So I've built this ahead of time so that you all wouldn't have to watch me build it leg by leg during this webinar. I'm going to open my NQ basket spread that I've created. So we can see here that I've got multiple legs. What this spread is doing is I'm going to trade the NQ future versus 3 of the constituent stocks. So Microsoft, Apple, and Netflix. And certainly these are just numbers that I came up with for a theoretical strategy. There is no limit to the number of legs you can add. So if you want to trade some sort of very large basket, say NQ versus a basket of 20, 30, 40, 50 stocks, that is absolutely possible. Keep in mind that the more legs that you add, when you get to a certain point, you will see a little bit of performance hit. So I certainly wouldn't recommend firing off 50 leg spreads frequently, but it does give you an idea of the power of this tool and the flexibility that we can provide. So in this case, I'm looking to buy an NQ future versus 100 Microsoft, 200 shares of Apple, 150 shares of Netflix. So let's take a look at what that spread's going to look like when we fill it. To avoid all the resizing, I'm just going to choose spreader only here. And because we've got so many equities in there, the top of book price, we're only going to see probably one or two, three or four quantity available at a time. Now you can certainly pay through the market, but in this case, I'm just going to buy a one lot so we can see what that trade looks like. So I'm going to buy a one lot of my basket. I'm going to pay through the market to make sure I get a fill. And let's take a look at our fill in our trade book. So we see that I did buy one NQ basket. That means I bought one NASDAQ future. I sold 100 shares of Microsoft, 150 shares of Netflix, 200 shares of Apple. You'll notice here that the Apple was a short sell. Now this is our internal environment, so I'm not actually selling any of these. This is our internal matching engine. However, this is nice to notice because what we are doing is we are reading your position as a user and determining whether you are long or short this stock, and we are sending it as a short sell in the case that you are already short this stock. So we do account for short sells in equities, and we can talk more about that if anybody is interested in equity trading. That's not unique to the spreader, of course, but it is for any equity trades that you make. You'll notice again that I've got these trades going into separate accounts. So now I want to take a look at our trade settings. So this is the way I have set this up, and certainly you can get as complex as you like, but in a very basic setup in my trading settings, in my global settings, I can see that all of my futures are set to go into my O1 account. All of my stocks are set up to go into my O2 account. That is, the spreader knows those settings and will execute into those accounts as specified. Now you can get, this is a global setting, so you can certainly get more granular. And so in this case, I've got settings for my ICE trades, my CME trades, my CFE trades. And if you remember when we trade the Brent versus crude, we had our crude trades going into our O1 account. That's for the CME exchange. And for the ICE exchange, we see that our future trades are going into the support O2 account. So that's just a very basic example of how you can set up your spreader instruments to be executed into your desired accounts. No need to move trades after the fact. So that's a good example of the power of this multi-asset platform where you can trade futures versus stocks. I did set up, in addition, just a very simple NVIDIA versus AMD spread. We had a customer who was looking at this spread, so we helped them set it up. Same kind of thing. If I want to execute that, and I'm just going to look at the spreader only, I'll go ahead and buy 100. Oh, missed my price. My 100 lot now, my NVIDIA versus AMD, I can see that my entry, I did get my entry price 38.93, and there are my individual legs on each side of the stock. You do see as well in my spreader component, I've created a couple of frequently traded spreads. These are not templated, but this is something that we can certainly help with if you are, for example, a treasuries trader and you trade the fight spread. That is very easy to set up in the desired ratio, which I believe is 3/2. Same thing with the knob, and then again with the crush, which is popular among ag traders. I got real granular. I took the ratios directly from the CME recommended ratios, both the quantity and the price. And so that's just an example of how you can set up the crush spread if you choose to trade that. So again, these are not templates. These would need to be set up individually on your own, and you could adjust those ratios as you see fit. I mentioned earlier the spreader functionality and said I would come back to that. So let's talk briefly. I'm sorry, I said spreader, I meant sniper functionality. So sniper is available for spreader orders. The way sniper works is sniper will work your desired price on our server without showing any orders to the market. So when your spread price meets your desired, when the spread meets your desired price, the sniper order will fire IOC orders at both legs of the spread. So this can be used, and once I click once I make one leg a sniper, they are all snipers. So in this configuration, we are neither quoting nor hedging. We are simply looking for our spread price, and firing when it lines up. So this is if you want to hide your size from the market. Some people will use this in less liquid markets because they, if they want to, have a size trade in something like a dairy product or a lightly traded instrument, and they don't want to influence the market by showing their large size, you can use this sniper order. It does come with a bit of risk because, as I mentioned, they are IOC orders, so you can certainly miss on a leg or more of the spread. That is just a risk inherent with sniper. You can use the hedge tick offset in this case, and this is what I would recommend if you're using a sniper order, and pay up a couple of ticks on both sides. Now, of course, this will reduce your chances of getting hung, but also has the potential to give you a spread price worse than your desired price by up to 2, in this case, up to 4 ticks, because we could pay up twice, pay up on each leg. I also want to talk briefly about what we call sometimes the no hedge strategy. And so what you can do here is you can set up a synthetic spread, and we'll use this ES versus NQ as an example, whereby you only trade one leg and you're using the other leg as reference. This is often used when looking at foreign currency. So if you could use, for example, the British pound as a reference for your spread. But if I wanted to set this up in a no hedge strategy, I can simply set my ES as the quote leg. In that case, it would be looking at NQ to determine the desired price, but there will be no hedge leg sent. I am simply trading the ES in this configuration against a specific price in the NASDAQ that will meet my desired spread price. So the no hedge strategy can be useful as well. That brings us to the end of this presentation. Again, there are plenty of intricacies and details that I kind of went through quickly just in the interest of this webinar. But as questions come up, or if there are any right now, again, please do reach out to me at any time or to our sales team at any time. We would love to speak to you more about the spreader and its capabilities. And we're very excited to get more people using the spreader, and you get an idea of how powerful this can be. Once again, this recording will be shared with you via email. So if you have anybody in your organization that was not able to attend this specific session, the recording will be available to you shortly, probably this afternoon when those follow-up emails go out. I do not see any questions currently in the chat. Kate, I don't know if there are any there that may not have been forwarded over.
I have no questions so far.
Right. Well, then perhaps I've done a terrific job explaining. Again, please do contact me or our sales team at any time with questions. And thank you very much again for attending today's webinar. Have a good afternoon.